Okay, so 2023, everybody is concerned about interest rates. We've got inflation, hopefully kind of getting a little more under control since last year, but still, every time the Fed meets and Jerome Powell opens his mouth, everybody wants to know what to hear, and the market is reacting, wildly to it, one way or the other, it seems. So the Fed just met yesterday. So I wanted to bring on John Wells from Morrison Wells to talk about the meeting and what their outlook is. So let's jump in. All right, John, how's it going, man?
Hi, Jeff. Things are going great. I'm glad to be here, and it's always a pleasure to chat with you.
Yeah, always good chatting, always insightful. So I want to know what you think about the Fed meeting yesterday. So it's kind of what everybody expected, that they held rates steady, weren't going to. I think it was funny at the beginning of the year. I remember everybody talking about, at least a lot of people, that they were pricing in and expecting a rate cut by the end of the year. Obviously, that hasn't happened. I don't know why everybody's so wrong all the time, but I mean, I think if anything, it was more expected that they might raise rates, yesterday. But I think what everybody anticipated was a holding steady pattern. So what are you guys seeing? I mean, why is everybody so wrong 6 months out? What are they seeing that you're not? I think you had mentioned that you guys weren't really anticipating any rate drops, early in the year when you were pricing and looking at, moving forward. So what were you guys seeing that everybody wasn't?
Yeah, Jeff, I think the Fed has struggled a bit with their messaging to the markets over the last 2-3 years. But I think they have become a little more focused, and the message was pretty clear from the beginning of the year that they were not going to lower rates or think of lowering rates until inflation was tamed. And you could tell in the press conference yesterday, Jerome Powell was pretty excited about the direction of inflation being down. He was also almost taking a victory lap on the fact that inflation was going down, but unemployment hadn't spiked up. So I think the Fed is trying to walk this delicate tightrope with taming inflation and hopefully not tanking the economy. And I think that's why the markets are so focused on on every word of the Fed these days.
Yeah, I mean, it's interesting. Like you said, he took a victory lap on some of the job numbers staying high, but I remember a week or two ago the numbers came out. Some of the economic numbers were positive, and so that was a negative thing. Like we dropped 300 points because they were afraid that it was going to be a sign of new rate hikes because inflation is still going to be holding steady. So where's the disconnect there?
Yeah, I think some of the wording yesterday. And you're seeing it in the reaction in the S&P 500 today. I think some of the wording yesterday gave the markets a sense that the Fed is happy with the direction of inflation, and therefore they're not necessarily thinking about raising rates or seeing that they have to raise rates going forward. So I think it was there was a pretty clear signal yesterday that at a minimum rates are going to be held steady. And Powell sort of walked this balance again between saying that inflation was coming down and that the economy was doing okay. And I think you're seeing that positive reaction by the markets today.
Yeah. I mean, so I'm curious then what your thought is. I mean, obviously, inflation starts rising. The idea is that the Fed is going to raise rates until something breaks. Mm-hmm. And we thought we kind of saw that with the banking crisis earlier in the spring, but inflation is still holding steady, slightly on a downward trend. I don't know if people are necessarily feeling that. Right. But so are you like you said, he's not going to be, looking to raise rates until something breaks. He's really trying to walk that fine line and kind of hold steady without kind of quickly dropping rates with or quickly dropping inflation with more rate hikes.
That's what it seems like, Jeff. And we are leaving room in our minds as investors that several things could still break. Right. The rise in rates over the last 18 months has been historic. And it's created a lot of pressure in certain areas. If you take it down to the company specific level, and if companies have a bunch of short-term debt, if a company has a bunch of short-term debt that it needs to roll, then it's really in a precarious position potentially given higher interest expense going forward,
Yeah.
to get that debt rolled over. So from a portfolio perspective, how we are trying to deal with a rising rate environment is by investing in companies that aren't significantly debt burdened, or don't have a lot of near-term debt to roll over, and that there are management teams that are able to manage through a rising rate environment. So it's not that we're not ignoring sort of the Fed, the Fed missives and the monthly announcements, but we're looking at companies on a sort of a company specific micro level, which helps mitigate the need to be overly concerned about directions of rates.
Yeah, we're overly reactive to a single meeting.
That's right. Yeah, that's right. Anecdotally, I was once in an interview with a money manager who said that, if anyone ever left the room during a meeting to go and see the results of the Fed announcement, they were fired. There's no you shouldn't be necessarily investing on those monthly movements. It's hard to take a long-term view if you're fretting over, a 25 basis point move in a given month.
Yeah, exactly. I am curious, and again, this is kind of more of a macro perspective, but what are your thoughts? Because I've been hearing this, and some people are kind of sounding alarms, like you said, and some of the short-term loans that are going to be rolling over, and they're just massive, some kind of domino effect potentially within that. Are you worried about that with some of these companies and how they might affect kind of the broader market?
No, we definitely are, and we're not ostriches. We're not just sticking our heads in the sand. I mean, the rising long-term rates definitely affect valuations, right? Interest rates are the bedrock of discount rates and of valuations for individual companies. One thing that we thought curious at the beginning of the year is right now the yield curve is inverted, right? So for echo traders, that just means that short-term interest rates are higher than long-term interest rates. And everyone assumed that the Fed was going to have to lower short-term rates in order to normalize the yield curve, meaning short-term rates would be lower than long-term rates. And we left the possibility in our minds and in our discussions in our investment meetings that long term, in order to for the yield curve to normalize, that long term rates could go up and short term rates could stay the same or go up a little more, and that's what we've seen happen the last couple of months, and that's freaked out the equity markets for it partially justified in our view and partially not justified.
Yeah, gotcha. Lastly, I mean, now that we're on the Fed meeting, because I think I've had some good insight from you in terms of kind of how you guys are managing the portfolio in relation to these meetings. But what are your thoughts on just the nature of the reaction of the market, like we talked about, and like you mentioned, earlier in another conversation, that there might have been some missteps, in the last couple of years. So what are your thoughts on how me personally, I'm not an economist, but having a central bank with their finger on the scale so much, it rubs me the wrong way, and I think it can, just have wilder swings than just letting the market. I'm a free market capitalist. What do you think? I don't want to get political about this, but what do you think that they've done wrong recently, or just the thought of having, so much control?
No, it's frustrating, Jeff, and just sort of generally speaking, we would suggest that the Federal Reserve kept the Fed funds rate lower for too long. Basically unnecessarily stimulative to the economy when the economy was doing just fine. I think that was the big misstep, and led to and granted, COVID came in the midst of that. But we remain stimulative at near full unemployment or full employment, and that probably led to some of the inflation that we're now trying to tame. So I'm assuming that they're doing the best job that they can, but I think there's some some culpability there in terms of going forward. I think they do have a difficult job. I think we haven't seen some interest rate sensitive markets necessarily correct, right? Housing prices, with rates going from 3% to 8%, one would think, that the housing market would sell off significantly. And I understand that it has in certain areas, but broadly speaking, it hasn't. We haven't really seen house price declines to match the rise in interest rates, and it's a tricky thing, because how does the Fed take into account that potentially the housing the number of houses is underbuilt? There's a low supply, right? So the low supply has kept kept prices up despite the interest rate rise. And I'm not sure the Fed has necessarily taken that, stuff like that into account. And it makes, it makes this very difficult. And the Fed also has this dual mandate of inflation at or near 2%, as well as maximum employment. So that is a very difficult balancing act. And as you say, they're trying to control the balance of the scale, but it's easy to understand that they overshoot and undershoot, and there's a good chance they do both. Within a 5 to 7 year span here.
Exactly. And as somebody who just made the terrible decision in this time to buy a house, I understand the rate and the pricing problems all too well. But yeah, no, John, appreciate you taking the time.
Thanks, Jeff. It's always great to talk to you, and we're happy to do it. Take care.
And investors, if you like what you heard here, hit subscribe. We're going to keep doing these, keep giving you insights from professional portfolio managers like John Wells at Morrison Wells.